As we setting aside what we've seen from OpenAI, this massive shuffle in tech over the past weekend, how does this set the scene for what we can expect this week?
Yeah, well, I mean, first of all, we clearly have a much quieter holiday impacted week. To your point though, there are some kind of notable events happening in markets. We saw one clearly over the weekend, as was just discussed. I think the bar is very high though for companies like Nvidia, for companies like Microsoft. I mean, I just as we step back and look at the valuations of the sector now, clearly they've been responsible for the move in equity markets. If you look at the average stock, look at a lot of other sectors, a very different picture emerges. So I think these companies have to continue to tell a pretty good story and really deliver on the very high expectations that exist in the market today for them.
And bringing into that then the Magnificent Seven, which obviously were responsible for most of the rally that we've seen so far this year, some of that filtering out to other sectors as well. But what are your estimates for how do you see the Magnificent Seven faring from here?
Yeah, we think they're really kind of towards the upper end of their range, in the near term. So we don't expect a lot of leadership from them. We, quite frankly, haven't really had it in the second half of this year. It's very much a tale of two halves to us in the equity market. But with the trajectory of the economy here, our expectations, at least next 2 to 3 quarters in particular, where we'll continue to see a little bit of a more macro slowdown, a little bit more of an impact from the Fed's higher for longer, the other factors that have contributed to some of the financial tightening that we're seeing. We think it's very much a time for the Magnificent Seven to once again to deliver on the very high expectations and maybe to grow into a little bit of the valuations that just absolutely surged in 2023.
And I know you mentioned some of perhaps a slowdown here, but could we be heading into correction territory once the market sort of settles into a lot of the Fed's efforts and the continuing tightening credit conditions will sort of really start showing up more so next year?
Yeah, and, that's where we really are firm believers that a lot of the tightening that happened really didn't hit until very early this year, and then we had a very significant pause. And the response to the banking strains we felt in March was actually injecting a lot of liquidity, both from the Fed as well as from the Treasury. By June, July, that started to unwind again, and we resumed this move to restrictive. And so, we think this lagged effect of monetary policy tightening is really hitting the economy now here in these next couple of quarters. So, we wouldn't be surprised if the range that's been established once again on something like the S&P 500, because of the Magnificent Seven, we feel like we're maybe at the upper end of that range in the near term, and we could see some some renewed volatility. Our view is that markets really price in pretty close to a Goldilocks scenario right now, whether we look at the equity markets or even turning to the bond market. The expectations for interest rate cuts in 2024, really are focused on, look, disinflation is going to continue. The economy will grow, but won't fall into a recession, and the labor market will weaken, but not overly so. It's a pretty rosy scenario. We think any pressure more on the downside, and you could see markets react a bit more negatively, certainly on the equity market.
And as you mentioned the bond market, which of course has been on a tear. Some pullback though in recent weeks here. Have people missed the boat? Is it too late to get into the bond market, or how are you playing the bond market right now?
Yeah, we don't think it is. As we look at particularly higher quality investment corporate bonds, still very attractive yields in the very high fives, even low 6% range for securities like that. You don't need to take a tremendous amount of duration. We think you can look in more the intermediate part of maturities. So we like things in 6, 7, 8 year maturities, trading at discounts to par value. And once again, the most attractive yields we've seen in several decades in that asset class. So we don't think it's too late. Now, if we get another shot with the 10-year Treasury up closer to 5%, we'd certainly be very focused on taking advantage of that opportunity. Quite frankly, we don't think we're going to get it. And looking at the asset class where it is today, we find it attractive.
And of course, coming to the tail end of earnings season, it's been interesting. I feel like the expectations were relatively low and they were met. What's your big takeaway from where we're coming out of this earnings season, especially a lot of the warnings we heard about the slowdown in the consumer?
Yeah, there's a lot of areas that I think we can point to in the equity market that are tied more to that consumer, where, the trend that we've seen these last 3 to 4 quarters, which initially started as a contribution to the profitability growth coming from both volumes and pricing. As we move forward through 2023, it became more and more difficult for many companies to deliver on volume growth, and they really have leaned much harder on the ability to pass pricing on to their customers. We think that's getting very long in the tooth. And as we move into 2024, expectations should be that that growth will be harder to find, both on the unit volume side because of the macro slowdown, and quite frankly, the ability to push price increases through is just getting more and more difficult for many companies.
Certainly, we'll have to be a lot more discerning heading into 2024. Appreciate you joining us this morning. Ed Perks, Franklin Income Investors Chief Investment Officer. Thank you so much.